This is the Legacy Wealth Code podcast, helping you build long-term wealth and a lasting legacy through real estate investing, tax strategies, and motivational stories from some of the most successful and influential people out there. Here are your hosts, real estate investor and entrepreneur, Michael Knotbaum, and real estate investor and attorney, Andrew Hook.
Hey guys, welcome back to another episode of the Legacy Wealth Code podcast. My name is Michael Knotbaum, here with my partner in crime, Andrew Hook.
Hey guys, how's it going?
So we are delighted to have today, Andrew and I talk about taxes a lot, right? But now we have somebody who actually is in this space as a professional, Alexis Gallati. Not just, we try to tell you what to do. She is the person that can do it for you. So Alexis is the founder of the tax strategist at Cerebral Tax Advisors and the Cerebral Wealth Academy. Also an author of Advanced Tax Planning for Medical Professionals. Over 20 years of high-level strategic planning, which I know Andrew and I talk about every single podcast. So we're delighted to have you. Alexis, thanks so much for joining us.
Yeah, thank you so much for having me here. I'm really excited.
So let's jump in. Obviously, I think you probably have seen a few of our episodes, but Andrew and I are always talking about build wealth with taxes, because a lot of people they have almost a negative connotation around taxes. Everyone almost like, I don't want to mess with the IRS. And what we've come to realize is there's such a huge difference between a tax preparer and a tax strategist. So talk about what that means to you and kind of how you have created your business around the strategy side.
Yeah, definitely. When I was working for regional and local CPA firms before going out on my own in 2014, that's really what majority of tax advisors, or I should say tax preparers, are. They're preparers. They look in arrears. They're reactive to situations, and that's important. I mean, you still need to know how to actually properly report things to the IRS and that compliance. But, especially with my husband being a physician and, at the time before starting Cerebral, he was in his residency and a couple of years out, and I noticed the writing on the wall. I mean, we were going to be shifting to another tax bracket. And so I wanted to know why the Warren Buffetts and the Bill Gates of the world, were getting that 15% tax bracket. And so that's when I really started to look at tax planning and being proactive in nature. And so that's really what my practice, Cerebral Tax Advisors, is all about, is being proactive and educating our clients on what is available to them. Even if there's strategies that they're not ready to take. It's more about the education, and all the strategies we use are court tested, IRS approved. We don't put anything on a tax return. We don't feel comfortable defending in an audit. So most clients, when they come to me, they're used to meeting with advisors once a year. It seems like after year end, and once they've prepared the return, they might get a few pieces of advice here and there. But that doesn't help with tax savings. You have to do a lot of the strategies during the year in order for them to apply for that year. So being proactive and working throughout the year is really, like I said, the cornerstone of Cerebral. And that's why having regularly scheduled meetings with your tax professional is imperative to make sure that we're up to date on your situation and we can apply strategies immediately.
Yeah, that's great. I mean, it's funny because a CPA that we've worked with for a number of years always says he views that the income tax, once it's time for your taxes to be done, as his report card for the year. And so many preparers, exactly like you said, totally, let me just check the boxes and tell you how much you owe. And it kind of, it's like I understand both sides of it, right? A tax preparer has 1,000 returns on their desk. They don't have time to go through and say, hey, Alexis, I figured out all these ways after spending hours of research, all these ways I can save you money. It's just going to take me a whole bunch more time to do it. That just doesn't happen with the regular tax preparer. And I think that, there's such a huge need for what you're doing on the tax strategy side. It's awesome.
Yeah, exactly. Like you said, I don't blame them because, that's what they're doing. They're tax return mills in a way. They're just pumping out the tax returns. And you got to remember too, most of America is not in a position where they're necessarily going to be doing a ton of tax planning. Physicians and healthcare professionals, I mean, they're just kind of in a different realm, in a different bracket, where, they really need to start looking at their situation more strategically so they can keep more of what they earn.
Yeah, agreed.
Alexis, touch a little bit if you can. One of the things that we talk about a lot is that, and you brought up Warren Buffett, for example, a lot of the time you read these sort of smoking gun articles and I think the initial thought process as well, these people are only doing this because they may have a team of tax attorneys and tax planners and professionals around them, and that's reserved only into the uber wealthy. But one of the things Mike and I try to coach and preach on a lot is that, yes, while there is a segment of the population that spends way more time and money looking at that because they have to, these exceptions and exemptions are applicable to everybody, and it's across the board. And I mean, what do you think, like, the run-of-the-mill upper middle class should be really spending time-wise with their tax planner? Do you recommend quarterly meetings? Do you recommend less than that, more than that? What does that kind of look like for you?
Well, it really depends on the person's situation. I mean, are you just strictly W-2? That's not going to require as much time as someone who owns multiple businesses or is in real estate. So at a bare minimum, they should be meeting with their advisor at least once a year. And I say more likely towards the end of the year. Doing a year-end projection would be very helpful to, one, help eliminate surprises. What are you going to owe on your tax return? Is there anything we can do before year end? So it's at least that little bit of proactivity once a year. Now, if you go all the way to the other side of the spectrum and you have multiple businesses or even just one business, then it's really important to meet at minimum twice a year. And that's what I do with my clients. I meet with them at least twice a year when they have a business. So then that way we're doing a mid-year projection, seeing how things are going. Do we need to tweak anything? And then we meet with them again at year end to basically do the same and make sure, hey, are we still on track to what we had before? Like with the Warren Buffetts of the world, like I'm sure that he's probably not meeting with his people quarterly, but he has people to meet with his people.
Yeah. That's when you made it.
Yeah, exactly. And I'm sure he's probably looking at like things on an overall, like big picture sort of plan. But for people, more in our situation, when you have multiple businesses, yes, you should be working with your advisor on a quarterly basis, even potentially a monthly basis. It depends on how big and how involved your business is. And so it really depends too on the business as well, especially for healthcare providers. If you have, your medical practice, for example, you're going to probably want to, like I said, at that minimum, do twice a year, and then, go from there.
So I had a client, so I'm still an active real estate agent as well. And I had a client about a year and a half ago. He was an anesthesiologist. They did a 1031 exchange out of a mobile home park in California, wanted to buy something in Florida. So sitting chatting with them, they had never heard of cost segregation and bonus depreciation. So I walked them through how that works. And, his wife was basically the property manager already. Like that's what she did. She was working with collecting all the rents, making sure everything is leased, all the things that you would normally do as a real estate professional. And I remember they bought something in Fort Myers area. And that year he paid, because they filed jointly, they paid zero taxes. And when we talk about building wealth and what that looks like in terms of, 5 years, if they did that for 5 years, what does that look like for your portfolio and what your legacy means to you? How often do you have people that are in a similar scenario to that, and how do you advise them?
Yeah, so I have clients that are into real estate and, the full spectrum of, doing real estate syndications all the way up to direct ownership, short-term, long-term, et cetera. And I love real estate for that fact that, it can really provide a great avenue for tax savings. And it just depends on the physician's position, and if they're married, if whether they're not married, and what they're able to do, even if they're single, and they could potentially do like a short-term rental and qualify for that short-term rental loophole. Yeah. That's amazing. And I have some clients that are like, hey, Alexis, I just don't have the time for direct ownership. So then, we look at real estate syndications, which don't have, the same first year sort of effects, tax effects as like a short-term rental does, or doing real estate professional status. But there's still opportunity in the long run, and depending upon their other assets they have, that can really help achieve that a lot of savings.
That's great. So, one of the things that we're always trying to look for too is like, what are some of the things that we spend a lot of time in the real estate side of things, but what are some of the things that maybe that we're missing that you would say are like, these are just kind of like everybody should be taking advantage of these tax strategies? Do you have a couple favorites that you like that you think are really good ones?
Yes. Probably my absolute favorite is the health savings account, the HSA. Anybody can do it as long as you have a high deductible health insurance plan. And so I advise my clients, even if they don't at the moment, maybe they have a low deductible, to take a look and see how much more the high deductible is, or like the tax savings in it. Or not tax savings, the cost savings, because obviously it depends on your situation and your health and, what you need for you and your family. But HSAs are wonderful because they're triple tax advantaged. The money goes in tax-free, it grows tax-free, and then it comes out tax-free if you use it for qualified medical expenses. So, and a lot of people, including myself, for our HSA, we will actually put the money in every year and not touch it, and we'll pay for our medical expenses out of pocket, and we'll save those receipts, and we'll submit those receipts in 30 years. There's no rule saying you have to submit the receipt as soon as you get it. You can hold on to that receipt for as long as you want, and with current laws. And when we actually will allow those funds to grow, because a lot of HSA accounts allow you, or I should say providers, allow you to invest that money into ETF or other stock, et cetera. So you can allow that to grow. And then in, let's say, 30 years, when you actually want to tap that money, that account has grown, and you can submit the receipts at that time. And if you have more money in there than you have receipts, it acts just like a regular pre-tax IRA, individual retirement account. You just take the money out, and if it's not for qualified medical expenses, then you just pay at your tax rate at the time.
I guess I was always thinking that when you put into those at the end of the year, whatever you put in, you had to use or you lost it. Am I thinking about some?
That's a flexible spending account. Yeah. So that's different than HSA. FSA. You got it.
That one letter is a big deal.
Always makes a big difference.
Exactly. Yeah.
And so is there a cap on how much that people can put in per year?
Yeah, it changes every year. In 2023, for a family plan, it's $7,750. And next year for 2024, it goes up to $8,300. And you have all the way until the filing of your tax return to actually make April 15th to have to fund that HSA. So There's still time for 2023 to do that if you have a qualified plan.
Okay. Yeah, that's great. All right. So what else? Because this one was good. So
yeah. My absolute other favorite is retirement. Depending upon your situation, even if you're just W-2, making sure you're maxing out your retirement. It seems so basic, but you'd be surprised the number of people that come my way that are not maximizing that benefit, especially if their employer offers some sort of match. So, if there is any sort of match, you got to make sure that you're taking advantage of that and putting in that minimum amount. Otherwise, you really should be maxing it out. And if you own a business, then you might want to take a look at cash balance plans as a defined benefit plan, as opposed to defined contribution plan, which is what a 401k is, or even a SEP IRA. I love cash balance plans. Oh, sorry, go ahead.
Yeah, so I was going to say, just for people that don't know the difference, explain what that would look like.
Yeah, so with a 401k, those are defined contribution plans. So what that means is that the IRS defines how much you're allowed to put into your plan. So for like 2023, the maximum you can do for your employee deferral is $22,500. Next year, it'll go up to $23,000. For a defined benefit plan, the IRS is defining the benefit that you are allowed to put in, that maximum amount you're allowed to put in by the time that you retire. And so when you set up the plan, you define that age. So let's say it's age 62. And if you're age 30, then you have 32 years to get up to that defined amount. And so right now it's about $3.5 million. It changes every year with inflation. And so you're able to put in a much higher dollar amount with a cash balance plan than you would with the 401k plan by itself. Even with the profit sharing, you're maxed out there at $66,000 for 2023. In 2024, it's $69,000. I have clients that, start this sort of plan, let's say around age 35. I mean, they're easily able to put in about six figures into their retirement. So it really allows you to put so much more away. Now there's some quirky things about them, which I'm happy to go into if you want, but
no, absolutely.
So, you have to fund it for a minimum of 3 years and keep it open for a minimum of 5. Now that's a general guideline. If, God forbid there's like another COVID, or, you decide like, hey, I'm not going to do 1099 work anymore and be an independent contractor anymore, have my own business, then you can close it down for legitimate business reasons. But in general, you need to keep it open for those few years. And then also too, it's a pre-tax account, I should mention. Both of them are. So this money is going in, you're getting a deduction for it, but you need to keep the growth of the account at a fairly consistent rate in order to take advantage of the tax benefits year after year, being able to put in that six-figure amount every single year. Because otherwise, if it grows too quickly, then you're going to reach that defined benefit amount a lot sooner, that 3.5 million, let's say, before age 62. And so then you won't be able to put in as much the next year. So like I said, there's a few nuances. It's definitely a much more advanced type retirement plan. And I highly recommend working with, professional to make sure that it's staying compliant and properly administered.
So, because I know you work a lot with the healthcare, like you said, your husband's a physician, and I think your parents were physicians as well, right? Which is kind of how you got indoctrinated into that whole realm. And you're like, I don't want to be on call at 2 a.m. I just want to help you guys save money. So I totally get it.
I do not have the science gene at all. I have the dollar gene in my head.
But so, for a W-2 income earner, if their business or, company they work for offers a retirement plan, they would not be able to do this cash retirement plan, cash option retirement plan?
No, so I would say the very universal answer to most things tax, it depends. Unfortunately.
You sound like an attorney there.
Yeah.
Yes. If you are W-2, but let's say you have $50,000, $60,000 of 1099 income, income as independent contractor, maybe you're doing consulting or you are doing some locum work on the side, then you can do that retirement contribution on top of what's happening in your employer's plan. The only thing you can't duplicate is the employee deferral, for example, in a 401k. So if you have a 401k in both spots, then you can't duplicate the employee deferral, but you can do the employer contribution between both.
Okay. Yeah, that's great. I mean, like so much value there to me that I think most people don't know about.
Yeah, and that's the majority of our clients are those that have at least $50,000, $60,000 of 1099 income. And if we have that, we're able to work so much magic in terms of retirement planning, deductions, making sure using proper entity, etc. And all of it together can really help save a ton of money.
Does it have to be 1099 or can it be K1 as well?
So when you start to get into K1, you start to get into things called controlled group and affiliated service group issues.
Okay.
So if let's say that you're a partner in a practice and you get a K1, but let's say there's 8 other physicians, then most likely you cannot create your own retirement account because of, even if it's completely independent income of the group, since you are a 8th owner in that partnership, you have to go and include any employees in that group in that plan.
Gotcha.
So in the plan that you've set up. So it doesn't work well in that situation. So you got to be very careful about those quirks. It's under ERISA rules. So it's ERISA. Mm-hmm. Don't ask me what the acronym is. I always forget it. But if you look up ERISA rules, that basically, those are rules that protect the employees, like the little guys, from the owners, not including them in any sort of retirement.
And it's kind of funny because one of the things we teach a lot is that the tax code is thousands of pages, and yet only very small amount of it actually tells you how the IRS can apply taxes. The rest of it is really how the IRS incentivizes you to do different things. And so it sounds to me like, some of the stuff you've already shared really is incentive based that most people I don't think really even know about. Now, how often do you work with small businesses? Like, is there some tax advantages that they should know about that they may not be taking advantage of?
Yeah, majority of our clients have small businesses. And, because like you said, to be honest, the code is really built for those that own businesses or have, investments. If you're strictly W-2, I hate to be the bearer of bad news, but there's really a limited amount of things you can do until you start getting into more investment type strategies like oil and gas or solar credits, things like that.
Short-term rentals.
Short-term rentals, exactly. Real estate as well. Yep, exactly.
Sorry, shameless plug.
No, exactly. No, that's right. And so when we start working with our clients, especially if they own businesses, we're looking at entity. Entity selection is such an important thing because even if you're only have $50,000-$60,000 of 1099 income, you can, if you go and choose the correct entity, it does open up a ton of doors in terms of different strategies, such as like if you only have $50,000 of 1099 income and you're a sole proprietorship, you can't run a loss due to a retirement contribution. So if you want to do any sort of retirement contribution on that $50,000 of revenue, assuming that you dwindle it down with other expenses to zero, then you really have to do an S corporation in order to take that loss and, do a retirement contribution based on the wages, which you just make that as high as possible, basically, to max out your retirement. But otherwise, I love to always look at what my clients' spending habits are and see how many personal expenses we can make to be legal business deductions through their business, like home office and mileage. I love per diem as well because that allows you to take additional deductions that you don't have to pay for. And I'd say per diem for lodging and meals and incidentals when you travel over 50 miles away. So it's great. That's a great strategy for locum workers that travel a lot. Those are some of my favorite. And so we always just look to make sure that you're maximizing it out as much as possible.
I like that. I'm going to put you on the spot here. I know we didn't chat about this at all prior to the show, but I'm getting ready to do a 1031, and I have a call with an intermediary tomorrow to start to ask some questions. But I just figured I'll fire them at you too if we have access. So
Okay.
I'm interested in. And I don't know how much 1031 work you do, but I suspect you've got some working knowledge of it, of course. But I'm interested in doing kind of a non-traditional exit on. So I'm selling a property that I own with 3 partners, and basically we're all going our different directions. And so we're not going to do, like a like kind replacement as far as, a typical just sell that property and buy another property. So I'm aware that there are some options out there that are like you can kind of go in on almost like a fractional ownership, and you can buy a bigger asset that you own, some percentage of, and that can be done in lieu of a 1031. Somebody was telling me that you can also do a scenario that's kind of similar to that, but as long as you're not touching that money, it can be some other company that you own, almost like the idea of kind of like a self-directed IRA. Do you have any knowledge of that? Is that something that you can actually do? Have you ever dealt with that or come across that?
I have not come across that before.
Okay.
But have you ever considered an opportunity zone or an opportunity fund?
Yes, I've kicked that around too. That's actually one of the things I wanted to explore a little bit with them tomorrow too. But tell me, I guess, a little bit more about your take on that.
Yeah. So what I love about opportunity funds is that you're able to. So with a normal 1031 exchange, if let's say you have proceeds of $1 million, but your gain is only $300,000. Well, in a normal 1031, you would have to move that full $1 million into the next project. Mm-hmm. But with an opportunity zone, you get to just move that the 300,000. Instead, you only have to invest the gain. And so then that helps to go and defer the gain until 2026. And so, I mean, these have been around for a good while, and
we're really like 2 years too late, right?
I know. Yeah. You at least get to defer for a couple years, and some of the programs that I've been introduced to have been really great. That they'll go and you get to defer that gain, but then you get a guaranteed 6% income every single year on that money, and then that money's tax free. And then when you have to go to pay those taxes, so it's for 2026, you pay it in 2027, they will provide a distribution to help cover the capital gains tax. And then, between that time and, 10 years, so usually your money does have to be tied up for 10 years, then they'll give you the appreciation that you have on that investment is tax-free as well. So it's a pretty sweet deal,
Yeah.
Especially if you don't need access to that money right away, then, you get to defer that gain. They'll help pay for it, essentially out of your distributions. And then and then 6% tax-free income guaranteed every year, plus the appreciations for tax-free. I mean,
yeah.
I wish I had some capital gains to put it. It doesn't have to be just from a 1031 exchange. It can be any capital gains. It can be even from, investments in the stock market, or even like if sometimes we'll have clients that will sell equity to a private equity firm, to the part of their practice, and we'll use that strategy. So that might be something to think about and discuss with them tomorrow.
Yeah, I like that.
Yeah, the opportunity zone thing, I always laugh because like we talked before the show, we're down here in Tampa, and I think the misconception people often have is opportunity zones must mean that it's a really bad neighborhood, and that's not the case. And there's a lot of examples, but one of them is downtown Tampa. Jeff Vinnick, who bought the Tampa Bay Lightning a number of years ago, started a project called Water Street, and it's about a $2-3 billion project, Andrew, you think, by the time it's done? Mm-hmm. And Bill Gates is one of the investors, and you can imagine how much it's going to be worth at the end of this. And conveniently, it was petitioned to be added as an opportunity zone. And I just laugh because it kind of always goes into that mindset that a lot of the tax code is really, it was written because there was very rich people petitioning for certain things. But what we try to teach everyone is that even though, yes, that might be the case, those are the same things that you can take advantage of if you know about them. Mm-hmm. And just most people just don't have access to the strategy side of taxes. They're just checking boxes or doing TurboTax and they never know about any of the stuff that's actually available. So we certainly appreciate you jumping on. So let me ask you, what are you in all the state? Like, what states are you taking clients from?
Yeah, we are all over. We have clients in 40 plus states. We're 100% virtual. And so, we have a ton of clients in California, Texas. Like I said, we're in 40 plus states. And so I don't think we have any in Kansas. So if anybody in Kansas wants to help check off that box for us, I'd appreciate that.
And who's your ideal avatar? Like, who, I know you deal a lot with the healthcare industry, but it sounds like you're pretty knowledgeable about small business, W-2 workers. Who are you looking for?
Yeah, so our ideal client are those that earn over $400,000 a year from all their sources, and also have 1099 income or income as an independent contractor of at least $50,000 to $60,000. With that, I'm able to provide a guarantee in our tax plan design services, which we guarantee to 2x their investment in our services. So if they pay us $10,000 to design a plan, I'm going to guarantee a minimum $20,000 per year in tax savings, or they get the plan for free. So, we're a very small boutique type firm. We only have about, at the time of this recording, about 120 clients that are on our tax maintenance packages. And that's by design. We have criteria to work with us, and we want to make sure that we're working with those that we know we can save a lot more than what you're paying us.
Yeah.
That's awesome.
That makes a lot of sense. It's
funny how synchronized the mission of what the Legacy Wealth Code is. When we created it, it was like, Andrew and I we met actually in a networking group, and both of us had similar goals for what we anticipated our net worth to look like in the future and what our legacy was to our family and our friends. And for us both, it's teaching other people how to build wealth, because I'm convinced, especially, granted I'm partial to real estate, but there's a lot of different investment vehicles, but I'm convinced that anyone could really be a multimillionaire if you have the right disciplines, you have the right network in your corner, because there's so many opportunities that people just don't take advantage of. And I just love the fact that your mission seems definitely in alignment with what we're doing.
Yeah, I 100% agree. And with Cerebral, like I said, I'm very big on education, and we don't sell any products. We don't get any commissions or kickbacks. And so those that work with us know we're, giving unbiased advice, and it truly is around education. I mean, if there's strategies that our clients don't feel comfortable with, that's fine. The more important thing is that we're bringing new ideas to the table, and that you know about them. So maybe in a couple of years, you're ready for that short-term rental,
So why do you think so many people, and when I say people, I would even say tax professionals, are so nervous about dealing with the IRS? I mean, it's almost like they steer their clients away from anything that might be, in the gray area, but it's not, it's not really in the gray area if you know about it and know how it works.
Yes, I agree. I think it's just because they probably don't have as much experience with the IRS or feel as comfortable in their own education or skills. I did a 3-year fellowship in IRS representation, and so I'm just very comfortable with it. Also, too, there are some areas where I'm a little more conservative than others, because I know the IRS, like meals, for example. I tell my clients, don't go crazy on trying to write off all your meals, because that's one area the IRS loves to nab people on. And it's such an easy area for people to see, like, hey, why'd you spend $10,000 last year and now it's $50,000? Well, it's just a very easy spot. So knowing where the IRS likes to audit more is important.
I guess the IRS workers were not buying eggs during this period, because that would make sense. That's where 10 to 50,000. That's almost automatic.
That's true. There's always some for inflation, but yeah. Otherwise, I've always loved tax and the fact that it's really more centered around law. I mean, it's really not that math related. All you need to know is basic arithmetic. And I actually even took the LSATs and was ready to go to law school. But my husband and I decided that medical school bills were enough for us at the time. Right. But yeah, it's just one of those things that, like I said before, a lot of preparers nowadays are just more into being tax return mills. But you can definitely see, especially with the advancements in AI, that if you're not giving proactive advice, then most likely those people will start to fade out.
Yeah, I would definitely agree with that.
Your fellowship that you just said you did on representing, I guess, individuals with regards to the IRS. What's the name of that? Just so that, I mean, I think that's something people should be asking their CPA, like, hey, do you have this? Is that something you do? Because, I mean, what a way to set yourself apart. So,
yeah, it's an NTPI fellowship. So NTPI is National Tax Professionals Institute.
Okay.
Hopefully I got that right.
Yeah.
But yes, they're really great with, like I said, doing that 3-year fellowship and just really making sure that their advisors, know how to properly handle everything, whether it's like offer and compromise or trying to get penalty abatements, things like that. Okay. So, in full disclosure, I don't do a ton of like offers and compromise or things like that. But, when it comes to maybe some back taxes or penalty abatement, I do those on a more regular basis.
Sure. Makes sense.
The first quarter is just how to stay on hold for hours and hours without losing your mind, because you're like, how come no one's picking up?
Well, that's where you tap into your tax professional, because they have a practitioner priority line, so we can usually get in a little bit faster. So, sometimes we are on hold a lot. Yeah.
So I tell you what, I mean, we certainly appreciate and I know that when we first did this, there's like 5 or 6 topics. So I'd like to proactively invite you back at some time in the future to cover some of these others, because you've definitely given us so much good stuff today. How can we help you? You need somebody in Kansas. What else can we do for you?
Love it. Yeah, I would love to be back on. I like I said, I love talking tax and providing help that can hopefully save people money, because the more we can take out of the IRS's pocket, the happier I am. So. But yeah, I actually have a website that's dedicated to legacy. So if you go to www.cerebraltaxadvisors.com/legacy, that will go and show you kind of what we offer. That has on there a free bonus tracker and year-end tax planning list. Go and check that out. Make sure you have kind of thought about everything before going and doing your tax return for the year, as well as a link to my book, which is Advanced Tax Planning for Medical Professionals. That was really a brain dump, basically, of a whole bunch of different strategies from real estate to the retirement to entities, etc. And so it was a real labor of love, and so many people have gotten so much value out of it, and which I'm very grateful for. And then also on there, I have Cerebral Wealth Academy, which I just created within the past few months to really go and educate those that have 1099 income, that $50,000, $60,000 of 1099 income, but are more do-it-yourselfers. Cerebral Tax Advisors, we're really a white glove hand-holding type of service. And so we really promote amazing communication, et cetera. But we have some people that come, that are perfect for us, but they're like, hey, we really want to do it ourselves. And so the Cerebral Wealth Academy will really help them do it on their own. And there is a $300 off coupon in there exclusively for Legacy's podcast. And then there's also a link there if you want more of that hand-holding white glove service. You can book a free discovery session with me and see if we're a good fit.
That's awesome.
That's great.
Yeah, and all of these links will be in the description of the podcast when it publishes here in a few days. Andrew, you got any final tax questions for the Wizard of Tax here? This has been great.
I don't, but Alexis, I really appreciate it. There was a lot of great information that you shared today, so thank you for your time and your wisdom.
Yeah, thank you so much. I really appreciate the two of you having me on.
Absolutely. Until next, guys, this has been the Legacy Wealth Code Podcast. Onward.
Thank you for joining us for another episode of the Legacy Wealth Code Podcast. If you enjoyed this episode, click subscribe now and never miss an episode. Until next time, onward.